Okay, I mean, I never have a problem with questions. You can ask as many questions as you want, but if you're looking for this stuff on video, I have a couple things I'll show you here. This is where you might actually start using the shorter video content. So just in chapter 2, you pop in here and you go to the video playlist. Now, some of these videos are a little bit dated, but the concepts are all still there. Okay, so the math, the numbers will be a little bit different, but I've got a bunch of sort of 10, 12-minute videos on CPP, so you can work through them. Okay, and then of course the class itself is recorded, so you can always watch the recording of the class when we're done. Okay. Okay. Now, just before we broke for coffee, Ryan, you had your question. Ryan, are you back? Are you out there? I don't want to answer the question if you're not back from your coffee break. We might wait for Ryan. I am going to answer that question anyways at some point here, but I'll wait till Ryan's back. And other than that, let's push on. Okay, so the next thing we look at, we touched already on early and late Canada pension plan. Okay. Oh, yeah. There was actually, and there's also one, Cam, where we have somebody graduating from CPP retirement or CPP disability to CPP retirement, right? So, yeah, a couple CPP podcasts. Okay. So, oh, I don't know. I think Andrew, you can ask me questions. It's fine. Whoever has questions, just bring them on. It's all good. Okay, so we saw this earlier. We know that you can start as early as 60, and all you have to do is apply. There is no other criteria. There used to be requirements for people to start early. That is no longer the case, or wait as late as 70. Okay, so there are really two different sets of scenarios here. So if you have somebody who has not started CPP and is age 60 right through to 70, then CPP contributions, ongoing CPP premiums, are mandatory as long as there's employment income or self-employment income. Okay, that's good. So that's true right through until age 70. And that's something to consider, that if you're between the ages of 65 and 70 and still working, are you really getting any value out of paying premiums? And that's where you have to go back and do the calculations we spent so much time on already this afternoon. If we have somebody who has started CPP at 60 and is still working, okay, so you're doing both. You got CPP and you're still working. Okay, this person must participate in what's called the post-retirement benefit, the PRB. And the way the PRB works, you'll continue contributing at the normal rate, the same rate as everybody else contributes. So you'll contribute on income up to YMPE. And in exchange for that, at a rate of 5.25%, Okay. And same deal, the employer would contribute, or if you're self-employed, you're contributing double. Okay. And what do you get out of that? Okay. Your CPP benefit will increase by about 2.5%. Okay, so let's say, for the sake of argument, that you're age 60. Okay, and you earn over YMPE this year, and you've started CPP. Okay, you're obviously still working because you're earning over YMPE. So you would contribute your 5.25%. Okay, and then starting at age 61, you would get another lifetime benefit added onto your CPP. So you're really just building up your CPP here. You would get, let's say, you're collecting $600 a month, just for the sake of argument here, from CPP. Okay, so starting at age 61, you'd have $600 times 2.5%. So call that $15 a month. And that would be added to your CPP benefit until death. Okay. Is everybody with me there? So it's just that post-retirement benefit is a little bit of an add-on to your existing CPP benefit. Okay. And then when you're 61, still working, everything else is still the same. Once again, you contribute to the PRB. You don't have a choice. And now, starting at age 62, you're going to get another roughly $15 a month added to your CPP benefit until death. Now, those amounts are actually not technically added directly to the CPP benefit. I used a little bit of shorthand here. And instead, what you're really going to get, so now at age 62, for example, you'll collect $600 a month from CPP. That'll be your CPP benefit. Plus, you'll collect $30 a month from the CPP PRB.
Is that two separate checks?
It's so if you were getting checks, it would be, but of course, almost always today paid electronically. But yes, it is really two separate amounts.
And if it's electronically, does it show up as two deposits separately, or is
that
it just...
I don't know. I'm not sure if it actually shows up as two distinct deposits. I don't really care about that, but it is significant that it's separate amounts because the $30 is not eligible for spousal income splitting. So it would be, if you work next year, Mark, it would be another $15. And the year after, another $15. So do you see the first year was 15, the second year it's 30, the third year it's 45, the fourth year would be 60, right? It just ends at death, Todd. Okay, so you cannot split this or share this, and it ends at death. It is indexed like any other benefit. Okay, that's good. Exactly, Mark. It's only yours. There's no spousal benefits in any way associated with this.
What if you get divorced? Does she get half of that?
So not half of the CPP credit, but that would potentially add to your income, which would add to your new ex's spousal support calculation. Okay. And possibly child support calculation if we had some of the aggressive child rearing plans we had earlier. Okay. It never ends, does it, Robert? Okay. It never ends.
To be a financial planner nowadays, you got to be a rocket scientist, basically.
Well, I think a big part of it is just knowing when you have to look things up, right? So I don't necessarily think you have to memorize all of this, but yeah, the rules do get quite complicated. And the post-retirement benefit is a good example of this. It's a place where, whatever, I mean, it's a nice little benefit. It honestly is generally a good return on investment for somebody over the age of, or sorry, between 60 and 65 for an employee. For a self-employed person, not so much. But it's just complicated. And I think that we don't do any favors sometimes when we create these very complicated benefits. Sorry, Paul, no, self-employed would still be 2.5. Okay. No, but I always maintain, I think that this is not even the first time I said this in this class, Esther, I always maintain that open book on this exam would not make a significant difference. I do not think that the percentage of people passing the exam would change if it were open book.
Too bad you can't call a friend, because I'd call you, Jason.
Nice. I am always booked on exam day. I'm always very careful of that. All right. Okay. Yeah. Nice, Grant. There you go. So I'll show the one other consideration here is from 65 to 70. If you are still working, this is where the PRB is optional. Okay, and it's still the same thing. You would contribute at 4.95%, sorry, 5.25%. And you would get a 2.5% boost to your CPP, paid as a CPP PRB. Okay, that's good. Yes, there you go, Mark. I forgot you asked that question. I knew I was coming to it, and there it is. Ryan, are you back yet? Still Ryanless. Okay. I don't want to answer Ryan's question until he's here. That's just rude. Okay. I told you I'd get there eventually, Mark. Now, actually, somebody gave this exact URL earlier. This is the quarterly report of the Canada Pension Plan. And this sheet is actually really good. This is a sheet that I would print off, keep one handy. You'll see it duplicated in a lot of those little advisor handbooks people get. Okay, it's quite nice. Almost every dollar amount figure we have seen shows up on here. Yeah, it's and it's referenced in the textbook. So yeah, I would lock this one in. Okay, it's a nice handy reference, and it really does help with some of the comprehension issues that come up. They even are good enough to give you some of the rules down here, sort of very financial planner friendly. Got this little chunk down here and this little chunk down here. These are both quite helpful, and they're both things that we have really worked through at this point. Okay, now we're going to end up referring back to it periodically. Notably, we're going to just get right away here. We did our CPP disability already. In a couple of minutes, we'll get to CPP for the kids of a disabled or deceased contributor. And that's where we'll see the 255.03. Okay. Thanks, Mark. Yeah. Okay. All right, so we actually already worked through a little CPP disability scenario. I've just got a little bit more to show you with CPP disability. Okay, and with CPP disability, first off, in order to collect this benefit, your disability must be severe and prolonged. And that is the exact language that's used in the CPP Disability Adjudicators Manual. So what that means, it means two things. Obviously, severe means that you cannot work and earn a meaningful income. Which really amounts to anything more than about $5,000 a year. It's just a shot over that, but whatever $5,000 a year is close enough for our purposes, requires adjudication. So that's where the CPP adjudicator would say, well, how much are you making? What's going on? And then anything over about $10,500 a year or thereabouts, and you're cut off altogether. So really, if you can earn an income, no CPP disability benefit. That's good. That's hard and fast. You can tell when the adjudicator's manual was written because it makes reference over and over and over again to sheltered workshops. I don't even know that there's still a thing called a sheltered workshop. Okay. Help me out here, Paul. Sorry, I'm not sure if I follow with their trade. Okay. It's much more harsh than an ONOC definition. It's that you literally can't do anything. Okay. Yeah, nothing meaningful here, Paul. So the example I always use here, so this is severe. We'll look at prolonged. Prolonged means that you're never going to recover. Now, there's a little bit of leniency for this. So it is possible if there's a very long recovery period, if you might be 5 or 10 years in rehab, but work after that is possible, CPP will pay for that as well. Okay. Yeah, so that changed about 4 years ago, Todd. I can't remember exactly. Okay. Yeah, it's more strict, Mark, than ENEOC. It's not an ENEOC definition. So ENEOC, so those that don't do a lot of disability insurance, ENEOC is one of the 3 sort of standard total disability definitions in a individual disability policy. And even with ENEOC, the definition is still based on able to work in a job for which you're reasonably skilled, educated, or experienced. Yeah. So this is really anything at all. Okay. So you're right, Todd. That used to be in there. We used to look for likelihood of death, but that's no longer in that definition. Okay. So actually, Grant, I would disagree with that here. The adjudicator's manual is very, very detailed. And it really does just give you this sort of hard and fast. This, if that person can work and earn an income, then no benefit. So it's, but the manual, like it cuts everybody off. It's a very difficult definition to collect under. Okay. Nice, Grant. I'm not trying to correct you. I only pointed out here because there is this incredibly detailed like hundreds of pages long adjudicator's manual. It's a very detailed document. So I don't know. It's to the point of ridiculousness, honestly. All right. That's good. So here's the example that I always use. Some of you might know this guy, actually. He's been around the business for a very long time. But there is an advisor in Saskatoon who was in a car crash. He was, if I remember right, car crash in the mid-70s. Okay. And in that crash, he lost both legs above the knee. He was not a financial advisor at the time. Now, I think intuitively, all of us would say that is a severe disability and that is a prolonged disability. Would that be fair? Okay. However, he went on to build a successful career as a financial advisor. That's good. Close to 50 years in the business now. So now, does he meet CPP's definition of disability? No, he does not. He meets the prolonged, but he does not meet severe, and the disability has to be both severe and prolonged. Okay, that's good. So it really is true, if you can work, doesn't matter how serious the disability really is. Okay, I mean, he's done really well, Stephen, right? That financially he's overcome any sort of challenge that way, but no benefit there. Okay. No, he's not Andrew. No. No, he's independent. No, disability tax credit is significantly different than this, Mark. Yeah. Quite a bit easier to qualify for disability tax credit. Okay, I don't know that guy, Andrew. So yeah. Not sure who that is, but. Okay. So we did the calculation earlier for CPP disability benefits. Now, the other thing that happens here, and we'll talk about this in more detail in a few slides, but plus the children of a contributor qualify for a benefit. Okay, and I showed the amount a minute ago. It's about $250 per month per child. There's a few other criteria to it, but that's really it. Okay. Now, CPP disability is generally considered first payer against most other kinds of benefits. Okay, what do I mean by that? Well, if you have other disability benefits, and that's a bunch of different stuff here, roughly in order, it goes like this. We look at EI, and then we would look at your provincial disability supports, and then your auto insurance benefits, and then your short-term disability, or sorry, your workplace disability plans, and then individual disability. Okay, so for the most part, this benefit gets paid first against those other benefits. So if you have a claim for any of those other benefits, they will say, hey, have you applied for CPP already? So the benefit here, Robert, it depends on the ages of the kids. If the kids are minors, then it's paid to the disabled person, to the CPP disability claimant. Sorry, 18 or under. The benefit is added to the CPP disability benefit. And if the kids are 18 to 25 and full-time students, they get the benefit directly. Okay, that's good. After that, the benefit ends. In all cases, though, it's always taxed to the kids. So like every other benefit from CPP, CPP disability is taxable. The kids' benefits are taxed to the kids, no matter who they're paid to. Okay. Oh, I missed workers' comp. I knew I missed something. I apologize. Yes, workers' comp does fit in here. There we go. Whew. Thank you. That's better. Okay. Yeah, same for the child survivor benefit, Mark. Yeah, there's one tiny little rule because we know we need more rules with the child survivor benefit. Yeah, only when on claim, Bonnie. That's right. Okay. Yeah, the provincial disability supports, this is, depends on the province you're in, but this is BCA or AISH or SED. What's the program in Manitoba called? I know it's part of MAP, but I can't remember what the actual program is called. Or ODSP. Okay, and so forth. So all your various provincial benefits. Okay. Yeah, so that's what's going to happen here, Robert, is let's say that you end up with a long-term disability claim. Okay. So you've been at your employer for a while, you end up disabled and unable to work, you submit a long-term disability claim. The insurer will pay the claim initially. They'll put you on claim, fine, no problem. But after they get a feel for the nature of your disability, they'll say, oh, we think that Robert's disability is probably going to meet the CPP definition. And now they'll send you the paperwork to apply for CPP disability. And they'll tell you, okay, Robert, you need to show us a CPP decision that says you've been declined for CPP disability. If you don't submit to CPP disability, then we're going to cut you off. Okay? And that's how all of these benefits will work, except EI. Yeah, no, not always, Andrew. The CPP, so the claims examiner can make that call. If it's going to be a relatively short LTD claim, they won't bother. Yeah, that's exactly right, Philip. It reduces their liability on those claims. Okay, and that's worked into your premiums. When you pay LTD premiums, everybody knows that. Now, there'd be some, it depends on the insurer too there, Andrew. Yeah, the difference though, Robert, is your CPP disability is taxable, while your long-term disability benefit is generally tax-free. Okay. Yeah, that's right. It's a hard definition to meet. Generally speaking, and I'm happy to hear other, happy is the right word, but interested to hear other examples. But in general, I hear CPP disability claims show up for serious back and spinal injuries, terminal cancer treatment, progressive conditions like MS and Parkinson's. And then I've heard a few examples lately. One of these was on the podcast actually, with carpal tunnel, which surprised me, but then I looked it up and there's actually a fair number of claims for carpal tunnel. and similar conditions. And the other one is mental health. Quite a few mental health claims as well. Okay. Yeah, it's always taxed to the kids, Cam. That's right. No matter who it's paid to. And yeah, stroke, Paul, if you had a stroke that rendered you unable to return to work. Yeah, that's true. That would do it. Okay. Yeah, I know it happens. That definitely happens. Yeah, absolutely. Okay. Yeah, even when the kids are under 18, it's still taxed to them, Andrew. That's right. Yes, that's exactly right. Yeah. Okay, and that's a good thing. We want that. That's what should happen.
I'm confused. How is it taxed to a child?
Child's still a taxpayer. There's no difference there. If you got a 7-year-old who makes income, they still file a tax return. There's no exception for age.
I thought, Jason, earlier though you said that or not putting words in your mouth, but that the kids, before they're 18, the money goes to the parents.
Yeah.
And after the 18, it goes directly to the children.
Right.
So is the check made out to the parents still? In like, how do they, or how does that work? Like, is it in trust, or how do they?
No, it's paid to the parent. It's literally added onto the parent's check until the kid gets to age 18. Yeah.
And they get a separate slip for the kid. I get you for a slip when it comes time for tax.
Yeah, they'll get a T4 RS, or sorry, a T4 CPP for the kid. Yeah, T4A, sorry. T4A
Yep.
CPP for the kid. Yeah. Okay. Yeah, it lowers the personal exemption, but who cares? It's not that big a deal. And no RSP deduction limit on that, Mark. Actually, sorry, CPP disability benefit does create RSP room. Yeah. So you could, I don't know that I would, but you could. Okay, because you're right. It's less income than the personal amount. You're quite right.
Okay, I'm confused. CPP disability benefit, isn't that for people that pay into CPP?
Yep.
How does a child get that when they've never worked?
It's the child of the person with the disability, right?
Okay, okay.
Yeah, in
Okay.
red in the middle left there, right? This guy right here, the children of the contributor. Okay. So yes, in order to, yeah, that's right. It's just, we know that that person needs a little bit more income because they have kids. It's a very common principle of benefits plans in Canada that when you have kids, we add a few bucks into them. And this is a pretty typical amount, somewhere between $200 to $400 a month is not unusual. Okay, now you must have contributed to CPP prior to your disability. Okay, so contributed here means that you earned at least 10% of YMPE in 4 of the 6 years prior to your disability. Okay, that's good.
Jason, that's just for not for the kids. The kids get a base regardless of 250. Or is this for kids as well, or this is just for individual?
So
CPP?
so the children's benefit is paid to the child of the contributor with the disability.
Right. So this 10% rule doesn't matter. They get 250, like the 250 goes to each child.
Okay, but if I didn't contribute to CPP, right?
Right. In this rule, yeah.
Then I can't have a claim, and therefore
Okay.
my kids would get nothing.
The kids will get nothing. Okay.
Right. So this is only where you have somebody who is a contributor, right? So this is the children of a contributor, where that contributor is on a benefit now. Okay.
I got it. And then the child gets $250 per month. The child of the disabled person gets the 250. I got
That's
it.
right. Yes. Yeah. Okay. Yeah,
Not
this
to
is
make things complicated, but back to our example of, paying yourself dividends, and I know that's further down the course, but it'd almost be smart for someone to at least do 10% of the YMPE, right? Just to make sure there's some benefit.
Again, yeah, it just goes back to how much other disability protection you have in place. So if you've got great disability insurance and good cash reserves and all that kind of stuff, I'm less concerned about it. But I think disability insurance in particular is an area where a lot of business owners really fall down. And I don't know who does a lot of disability work on the call. So, for business owners, you get into trouble sometimes with residual and partial benefits, right? It doesn't always work out how we want it to. Okay. Sorry, Esther, back to your question from so long ago. Yes, this is completely unrelated, Esther, to the Canada Child Benefit. Okay, the two are completely different benefits. And yeah, Robert, as long as you're for the past 6 years, right? So if you took a year off, just 1 year off to go to school, you'd be still able to submit a claim. Okay. Again, Mark, it's just the for the past 6 years. So that's your criteria here to collect. It ends at age 25, Grant, that's right, or when that student is no longer, or when that child is no longer a student. Okay. Yeah, Robert, I am a huge fan of disability insurance, and it's exactly what Janelle just said. It bugs me so much when people say, I don't want it, it's too expensive. Now, I think we do some bad stuff there too. I think the industry doesn't necessarily have great lessons around disability insurance. We'll talk about that in chapter 12, okay? So the 17% won't help you to get to the 4 years, Paul. The 17% will only help to calculate the benefit, okay? So you're not ignoring those years. I like that way of looking at it, though. That's fun. But no, you're not ignoring those years. You're just increasing your math, okay? Okay. And I think group disability has gotten a lot better, Mark. I think when you look at what's happened the last 4 or 5 years with group disability insurance, it's substantially better than it was. Okay. Okay. Yeah, so I say child here. We have a very, very broad definition of child for the purpose of this program. This would really be any child where you have a parental role. So a stepchild or adopted child, those would all qualify here. Okay, good. You're just making your math, well, you're making the math better, Robert. All right. Okay. But you still have to qualify for the 4 of the past 6 years. Yeah. Okay. Yeah, so you would not, Philip, if you have somebody who's on a CPP disability claim, you would not take CPP retirement at age 60. It just doesn't make sense, right? You would run that benefit until 65 and then switch to CPP retirement. It's really the only thing that makes sense. Okay.
Jason, it sounds like and just as you said before, the math is always going to work to not take CPP if you're on disability until age 65. It sounds
Right.
like that's
yeah, that's right. In
Okay.
fact, there's a change in the 2018 federal budget that says if you started your CPP at 60 and you become disabled between 60 and 65, you can really essentially retroactively decide not to have started CPP at 60 and switch to the more generous CPP disability benefits. Okay. Yeah, again with the rules, eh? They just keep coming, don't they? Okay. Good. So no, that's a different set of rules you're thinking about here, Philip. Okay. You're thinking of returning your CPP retirement benefit. This is only if you become disabled. Okay. And that's only for 12 months, right? So you can, if you took your CPP retirement at age 60 and you change your mind, you say, oh, that was a mistake, I shouldn't have done that. You can repay up to 12 months of benefits and essentially go back to the state you were in before you started them. Okay. That's what you're thinking of, Philip? The rule I just mentioned is for somebody who becomes disabled at some point between 60 and 65. Okay. Yeah, that was in the 2018 federal budget. Yeah. Okay. That's why we're here, right? Okay. So then CPP death benefits and survivor's benefits. So first off, to leave behind a death benefit, again, you have to be a contributor. Okay. So you must have been a contributor to the plan. And being a contributor here means that you earn 10% of YMPE for the lesser of either 1/3 of your contributory period or 10 years. Okay, so whichever one of those things it happens to be. So I'll show you the circumstance where this becomes relevant. Let's say that I have somebody who first comes to Canada at age 40. Okay, everybody's with me here. And this person becomes disabled. They have a severe and prolonged disability at age 47. Okay, so by age 47, this person will have a contributory period of 29 years. That's right. Everybody agree with that? If they started work at age 40, and let's assume they did, okay, they started work at age 40, that's 7 years of contribution out of 29 years. That's whatever it is, 23%, 24%, which is less than 1/3 and less than 10 years. So they would have no survivor or death benefit left behind. Oh, sorry, they don't become disabled, they die. I apologize, I forgot what slide I was on. There, that's better. Dies at age 47. Sorry about that. And that means there's no survivor's benefit and no lump sum death benefit. Okay, I'm really badly disabled, Philip, right? There you go. Easy. Their spouse would have to keep them in the deep freeze for 3 years and then submit the claim, then we'd be okay. Okay. Yes. I mean, it's all relative, Robert, right? Okay. So, oh, there. So Ryan, did you get my comment before about first payer, CPP and first payer? Were you there for that? Okay, good, good. That answered your question? AISH does exactly the same thing. Okay, even for somebody who's, and this is everybody who applies for AISH is first going to be told, go apply for CPP disability, even if they know you're not going to qualify.
I have a question.
Yeah.
So if somebody started at 18 and then died at 25 and they paid into CPP, they wouldn't qualify because they wouldn't meet, you know, that 1/3 of their contributory period. Or do they do it from when they died to, you know, the year they started? It would be, their contributory period would be longer, wouldn't it? Or how would that be calculated?
No, that's only a 7-year contributory period. They would have contributed for 7 years out of a 7-year contributory period.
So you have to be a minimum of 10 or you
No,
can't.
it's the lesser of those two amounts. So the lesser of 1/3 of your contributory period or 10 years. So for that person, it's easy. They're 100% of their contributory period.
Oh, I see what you're saying. Okay.
Yeah.
Got
Okay.
it.
So the survivor's benefit, okay, it cannot, Robert, no, the contributory period is 18, that's it, cold, hard and fast, okay? Okay, so the survivor's benefit is calculated the same way as the retirement benefit. So you do exactly the same calculations we did back when we started this whole mess, okay? And then we figure out who you left behind. Okay, so who did you leave behind? If you left behind a spouse or common law partner who is under the age of 65, then that person gets a benefit based on a flat amount plus about $175. Sorry, let me fix that. That person gets a flat amount of $197.34 plus 37.5% of the calculation that we did up above. Which is normally around $500 to $600. That's typically what you can look at from a CPP retirement benefit. That's actually a fair bit of money when we look at an entire sort of adult life of benefits. So normally around $500 to $600. Is it taxable? Yes, it is. It's taxable income. Okay, every dollar paid out of CPP is taxable. Okay, if you left behind, so you leave behind a spouse or a common law partner, exactly right, Philip. That's just the rule, Robert. It's just 37.5%, just like the 75% we had earlier and the 25% we had before that. Okay, it's just the rule. Okay, if you leave behind a spouse or common law partner who's age 65 or older, then it's just 60% of your calculated benefit up to the CPP maximum. And the CPP maximum is the same CPP maximum we're used to, $1,175.83. Okay. Yeah, that quarterly report, Mark, I showed that, right? It's quite useful. It has all of these figures on it. The 37.5% is literally in one of the boxes that I outlined on that sheet before, right? So yes, I do recommend that. Keep that thing handy. It's very helpful while you're studying. Okay. Now, what this means, the fact that there's a maximum here at age 60, this means that if I have two blue people married to each other, there will be no CPP survivor's benefit. Because both will hit the max on their own. And because they're at the max, you can't go any higher than that. Okay. Remember my fairness comments earlier. Well, here we go again. What happens here is when the younger spouse or common law partner gets to age 65, then we calculate the benefit based on the 60% calculation. And it is very normal for people to run into that CPP max at that point. No, so Bonnie, you're allowed to remarry. That's perfectly fine. You can still collect that benefit. You with me there? The sort of weird rule here is that if you lost two spouses, so you were married once and that person died, and then you're married again and that person died, you would only collect the larger of the two survivors' benefits. So you can't be collecting two survivors' benefits concurrently. Okay. You can insert your own financial planning joke here about how such a thing happens. But I actually had a student once where his mom had exactly that thing happen. He grew up in, I want to say Cranbrook, somewhere in that area anyways. And his mom's first husband was a logger and was killed in a logging accident. And her second husband was a miner and was killed in a mining accident. And she only had the one CPP survivor's benefit afterwards. Okay. That's all good?
So Jason, maybe you're going down this road with the next area, but like say if you had someone with they could take CPP at 60, but they have a survivor benefit. I guess if the benefit doesn't amount to the maximum benefit for one person, which is 1175, they would take it right away. They would take their CPP, right? That's
Okay,
kind of the,
so no, this doesn't really work this way, because what happens is if you retire at 60, for example, then your maximum, the CPP max, is still, it's 1175 minus 36%, right? So you're still subject to the same limitations. You can't sort of time your CPP to squeeze the most out of that survivor's benefit.
I don't know how to give an example there, but say if someone, say the survivor benefit was like 700. So they may want to, if they're getting a survivor benefit, because they can't get more than what a maximum person can get, they're probably better off delaying their CPP till 65.
It's really going to be just the same. Yes, that's true. That person probably shouldn't start early. That I agree with. And then between 65 and 70, that's where it's a little bit of a tougher decision. That's where you have to really look at the value of delaying versus the benefit of taking it early. But yes, that person might be wise to delay. It's true. Yeah. Okay. Now
Jason, couldn't it'd be a significant impact though? Say if someone delays till 65 and just takes the survivor benefit, they're going to get a lot more at 65. It's a big. Would they stop you from doing that if you went to? Would they do the math on it and say, well, you shouldn't be trying to get your CPP because you're better off delaying, or probably not?
no, they'll pay you till you start your own CPP benefit. That's fine.
So they'd allow you to make your mistake that you shouldn't have really took it.
That's true too. Yes. Yeah. Okay. I know, Esther, that's my comment about not being fair, right? So it's just, I don't know, Esther, what the policy reason for that decision is, but yes, two blue people are going to get a raw deal compared to two orange people, let's say, from my earlier example. Okay, thanks, Todd. That's good. Okay.
That was just in regards to his question. That's what she would get.
Yeah.
The 822.50. So
Yeah,
I think it would be better for her to wait to 65 and she would get a larger amount because the
wait.
maximum is higher at age 65.
Yeah, the max is higher. So, but again, then the question is, you know, you have the money in your hand. Would you rather have 5 years of cash in your? I think most people are better to wait for what it's worth, but it's always that question of would you rather have 5 years of cash in your hand, do something with it, or wait and get a larger income, right? And yeah, no, you're not missing something, Esther. Yeah, Bonnie, that kind of goes. I can't remember who asked that question earlier, but that kind of goes back to the question that came up earlier about not declaring somebody as a partner. No, there's no reason not to do that. She can still get her survivor's benefit. Okay. Yeah. Okay. So then I sometimes think, Bonnie, when people say that kind of thing, that what they're really trying to do here is sort of have like a soft sell to their new partner. They don't really want to be in a formal relationship with that person. You know what I mean? It's like an excuse not to be committed emotionally. Yeah, and I do find the Government of Canada website is actually pretty good for this stuff, Mark. Yeah. Okay. Now, the other thing this person will get, there is a $2,500 lump sum death benefit paid usually to whoever arranges the funeral. This is almost always applied for through the funeral director. So the funeral director generally gets that person who comes to see them to fill out the application, and the funeral director likes it because it's a little bit of cash that goes towards paying for the funeral. Okay. Yeah, that happens too, Bonnie. I know. And then there's also a children's benefit here, just like we saw on the previous slide. So there is also that roughly $250 per month per child. And again, that's paid until age 18 or age 25 if the child is a full-time student. And this is something we didn't have before. It can, Stephen. Yeah, some people pay that cash directly to the funeral home. You can ask CPP to direct it directly to the funeral home. They will do that. It's also paid for lifetime if you leave behind a child who was disabled and dependent on you due to their own disability before age 18. Okay. It's true, Philip. That's exactly right. Like everything else we've seen, the $2,500 is taxable. Okay, that's good. All right, so much CPP, eh? Yeah, now Todd, every funeral director in the world is going to make sure you apply for the $2,500. Okay. So as long as you're going to actually get rid of the body in a legal manner, you're going to have this handled. It might be the executor, Mark. It's not always. There's tons of variability there, but yeah, it often would be. It's taxable to whoever got the amount, Cam. I think that's your question. It's not to the estate, sorry. It's to a person. It's never taxable to the estate. It's to a person.
What about the $250 to the child? Don't you have to know to apply for that or no?
So same thing though. The funeral director is normally going to make sure that that gets done. But if you don't. And I have seen at least one case where somebody should have been collecting these benefits and was not. So yeah, people should be aware of it. That's why we have financial planners, right? No, so this is death at any age, Andrew. Okay. Oh, there you go, Philip, right? I mean, it's a bad example, but yeah, I mean, to be fair, they do this all the time, Mark, right? That's literally what they do, is help dead people deal with, fairly emotional, fairly complex issues. Yeah. Okay. Although it sounds like in Philip's case, maybe that wasn't made clear. Okay. That's all good. Did she arrange the funeral, Philip? Is that what happened there? Okay. Yeah. Okay, we did that. That's good. We're good there. Okay. So there's not a cutoff time to ask for them, Paul, but they'll only pay 12 months of benefits retroactively. Yeah, always those gentle reminders about that, right, Philip? Nothing like an extra $1,000 in taxes to pay to remind you of that. Okay. It is good timing, Mark. Yeah, it is good timing. Okay. So there's our quarterly report again. And same thing, it has all these figures we just went through on it. Quite helpful. We talked about the kids already. We talked about the death benefit. All right, so this issue came up earlier, this question around the Canada Pension Plan Investment Board and the funding of Canada Pension Plan. Okay, so back in 1997, the federal government looked at the CPP, which up until that point was a pay-as-you-go plan. It was funded out of general revenues, which meant there was no cash reserves, there was no investment component. A bunch of people paid into it. That money went straight to government coffers. The government had that pool of dollars, and they paid out any benefits that had to be paid. Okay, that's good. Which, by the way, is exactly how old age security still works today. Okay, old age security, there's no contributions to it, but there's no reserves for it. The government just pays out old age security benefits straight out of tax revenue. Okay, but in 1997, the government looked at this and said, this may not be ideal. The challenge here will be that we have this aging population. The baby boom generation is going to get to a point where there are more of them who are retired than the younger generations who are still working. So they recognize this likely imbalance that's going to show up in our demographics. And it's going to start by about 2030. So if we fast forward about 10 years from now, we're going to have this sort of teeter-totter that favors, it's going to have more retired people in it than working people in it. That makes sense? We'll tip the scales where we'll have more working people than retired people. Okay. So, well, the nice thing is, Todd, that they did recognize that relatively early. So this is still quite a while ago, really, right? This is 23 years ago. Okay. So the deal now is that we pay our CPP premiums. Those go to the government of Canada. Okay. They pay benefits out of that. And then the net amount, everything's left, the surplus, that goes to the CPP Investment Board. Okay, and the CPP Investment Board operates like a sovereign wealth fund. They go and invest this money. They're sitting on just shy of $400 billion today. And they've done very well with our money. Okay, it's been, yeah, that's true, Stephen, right? But they have done well with this. They have good annualized returns. You would be happy as a mutual fund investor what's happened here. So this has been just fine. There are a couple CFPs, a lot of CFAs there. So that's where you'll find tons of CFAs. Yeah. Okay. And it's a good group. You'll see this, that whoever runs CPPIB, typically they'll be there for 10 or 12 years, and then they'll get hired away by one of the other big Canadian fund managers to go run those funds. They make civil servant wages. They don't make fund manager money. So sort of a public service element to it almost. Okay. Come on, Grant. All right. No resets, Esther. You can't put $400 billion into a seg fund like that. It does not work like that. Okay. There are ways to do that. Okay. So maybe a little more than that, Robert, but they're not, like a lot of times those folks could go to, say, a US hedge fund and make tens of millions of dollars a year, right? Oh, okay. Well, so I would say $180,000 a year is not that much money for an asset manager in that scenario. Okay. It's not huge, Bev. Might be 20 or $30 million a year, but it does give them a little bit of float. Okay. Yes. So that shows up on that quarterly report, Robert. Actually, we can have a look at that in a second. We'll pop back there. The other comment I have about this is that our actuarial projections show at least 75 years. That's as far really as they'll go. 75 years of sort of good health for this thing. As long as it maintains, it has to get returns. It's a real return of, I think it's 4.75% is what we need to get here. So that means it has to beat inflation by 4.75% consistently, which actually might be tough over the next 10 years. We'll see. Okay. That's good. Okay. What's paid out? So you see the amounts for January and paid out about in January for $4 billion. So take that times 12, you're looking at roughly $50 billion a year. Okay. Okay, that's good. All right. Again, the quarterly report, it has lots of stuff on it, right? Okay, CPP sharing. So this is where we're going to look at how this thing treats spouses and common law couples for that matter. So CPP sharing is what happens when I have two people who are either married or common law, And we don't care about same sex or opposite sex here. That's completely irrelevant. So these folks are both collecting CPP benefits, okay, or one is old enough to collect CPP benefits but never contributed. Okay, that's all good. And what happens here is we would look at, and this is a little bit complicated, but this is how it works. So this couple, and I'll make them the same age just for the sake of simplicity here. So both were 18. At 30 is when they met and got married. That's the first time they were in a relationship. Okay, so now this couple gets to age 65 and both have started CPP. Okay, that's good. And let's say for the sake of argument here that, I won't use Alice, Alan is making $1,100 a month. That's his CPP benefit. And Brenda is making $700 a month. That's her CPP benefit. That's good. So they want to share their CPP. Well, what's going to happen here is we'll take a portion of Alan's CPP benefit, not the whole thing. He cannot split it all. He can only split what he earned while they were together. We're going to take that $1,100 times 30 years out of 47 years. And for Brenda, we're going to take her $700 times 30 years out of 47 years. And that will describe for us what they can split. So Alan can split did I do that right? Oh, 35 years, sorry. That's a good point, thank you. 35 years, just like I have on the board, Grant. All right, so we've got 1,100 times $819 that we can split. I'm pretty sure splittable is not a word, but I'm going to use it that way anyway. And $521 that can be split. Yeah, it's actually easier than that even. So what actually will happen here is they will just apply to Service Canada, and that will change their checks. So the amount they will get will now be different on that basis. Okay. Now, what this means for Alan, he cannot split $1,100 minus $819. Okay, so Alan cannot split $281. That's good. And Brenda cannot split $700, sorry, minus 521. So she can't split $179. Okay. Yes, exactly right, Robert. So what's going to happen here once we know that, and you don't have to, I mean, you have to do this math. Brenda and Alan don't have to do this math. They will just apply to Service Canada and they'll say, we want to split our benefit. And then Service Canada will take the splittable amounts and throw those into the magical splitting machine and end up paying out Then we're going to change this. So now that's going to be take 819 plus 521. That gives me $1,340. And then just divide that by 2. That's $670 each. Okay, yeah, I'll get there in a second, Carla. It's probably the most important question. Why do all this math if not for any benefit? Okay, so now Alan is going to have a benefit of, what does that come to, $951. That's right. And thanks, Tricia. Yeah, perfect. And Brenda's going to have a benefit of $849. Is that right? Should be $849, I think, Todd, right? Okay. And yeah, so that's exactly what we've done here, Andrew. That's exactly right. So before we split, Alan had $1,100 a month of income. He was probably the higher income earner if he's got the better CPP, right? And now we had Brenda with 849. Sorry, with 700. Okay, and she was probably the lower earner. So we've really moved here $149 of income per month from Alan to Brenda. Which should reduce their tax bill and potentially reduce OAS clawback for Alan. That's exactly right. Okay, it won't help with GIS. Well, even if he's not still working, if he's got a pension or investment income or the bigger RIF, those things could all still affect this, right? Okay. And there's really no work in it, okay? Now, it does not change their benefits. So the survivor's benefits, any disability benefit, that stuff is all still based on the 1100 and 700, okay? So if we have to later calculate a survivor's benefit, it's still based on the original amounts. Okay, that's good. So you don't get to split and then also use the split amount to do your other benefits, okay? And you can undo the split. So if it doesn't make sense to do it at some point, you can just apply back to Service Canada and have it flipped off. No, so you actually do apply to Service Canada to have it split. Brian, it's pension income that you're thinking of. It's pension income that is split just on your tax return. Okay. Very similar grant. Yeah, in fact, that's the next slide. Okay. Yes, that's right. Yeah, yeah, that's right. So if you wait till deep into retirement to do this, it's not retroactive. Yeah, that's true, Andrew. Yeah. Okay. Perfect. Okay. So then CPP splitting. And this is what happens when we have a couple, married or common law couple, and the relationship ends. And now we split the CPP credits. Okay, and the math is just what I just showed. You would do the same thing. You would figure out what each earned while together, and then put that into the splitter and spit back out half each. Okay, so the idea here is for the time together, they will have contributed equally to the Canada Pension Plan. Now, you have 3 years following a separation to apply, and 4 years following a marriage. So if you were only common law, then you have 3 years to take care of this, 4 years after marriage, or you can go longer if you get your spouse's consent after 4 years. Okay. It's actually not, Grant, that depends on the province. So some provinces in their Family Law Property Act or the Matrimonial Property Act, whatever it's called in the various provinces, some provinces actually, excuse me, allow you to negotiate the split as part of your broader negotiations. In some provinces, it is mandatory. So it depends on what the family law legislation says in that particular province. Okay, and I don't know every province's rules for that, Grant.
Jason, this is something back to the 3 years following separation. It's something they have to apply for. I always thought it was something that was automatic. You had no choice. I guess it's what you're talking about now. But like, say when it's comes time to do CPP, they automatically adjust the credits if you're divorced. Is that no?
You still have to tell them.
So if I get divorced today, I have to tell them within 3 years to actually to get the split.
If you get divorced, it's 4 years.
Okay.
Right, because that divorce is marriage. Now, so we'll talk about this a little more in chapter 6, but if you went through a divorce, right, and the divorce agreement, the separation agreement that ended the marriage said the CPP was supposed to be split, but nobody bothered to apply for it, then presumably that would still be enforceable later on. You would need your spouse's consent, or your spouse would need your consent, as the case may be, to split it, but it still would be splittable later on. Just need that consent then. Okay. So it's split as of date of separation, Bonnie, regardless of, yeah, because you're no longer, for this purpose, you're no longer together on that date. Now that's confusing because in Alberta, there's a different date for division of other assets, right? Yes, it very well might, Bev. I agree with that. That's where you're better just to get it done sooner. Again, Bev, this is why people need financial planners, right? I mean, anybody can sue anybody, Stephen, right? That's always the rule you should go by. Yeah, does your CFP professional have an obligation to inform you? Partly, I would say the family lawyer would be the one who would be number one on the hook for that. Okay. Yeah, that's true, Bonnie. So that kind of goes back to Bev's point. If you have one of those divorces, those nightmare situations that drags on and drags on and drags on, then most likely the separation agreement ultimately will say that the one partner is going to provide that consent to the other to make the CPP split happen. Okay. Good family lawyers, Andrew, do take this into account. Okay. However, it is not unusual in law, just like it is not unusual in many other fields, to see people sort of dabble, and you definitely do get some of that. Okay. Yeah, you could make the same argument, Cam, but I would still suggest that the family lawyer would be number one on the hook there, and everybody else would be co-named. Now, the other question here, Stephen, is really how much harm is there? Maybe if you had a really big discrepancy in CPP benefits and a really long time together. But if it was even the scenario I just showed, it was $120 a month. I don't know. That's a hard thing to sue somebody over. Okay. Yeah, $1,200 a year for 30 years. I don't know. Okay. Yeah, I do see that sometimes, Mark. Yeah, and some of it is just, I don't know, sometimes people feel like they just don't, whatever, they don't need to go and fight for every dollar, right? That really does happen. Okay. That's good. All right. So much earlier, this question came up about the rate getting more expensive. So what's happened here? In 2018, the federal government said, hey, we don't think CPP is going to be enough for the real, like the younger crowd who is potentially not saving at the right rates and not doing a good job sort of taking care of themselves. And therefore, we are going to boost the CPP a little bit. So the first thing that's happening here is that we're seeing the rate change. So what was 4.95% in 2018 is now 5.25%. And next year it'll be 5.45, and the year after that 5.7, and the year after that 5.95. Okay. So we will end up at that 5.95% rate. Now, the next thing that's happening is in 2024 and 2025, the dollars that we contribute on will be more. So today we contribute based on YMPE. By 2025 then, you'll be contributing like this. So let's use YMPE from 2020 just because we have the figure handy here. It's 57.4, is that right? Okay. This is just the employee portion, Robert, so the employer portion would be double that. Yeah. Okay. So 57.4, right? Anyways, whatever. Let's assume it is. So minus 3,500. No, it's not. Sorry, what's my YMPE? $58.7. Thanks, Mark. I just found it there too. Okay. I knew that wasn't right. All right, 58.7. Times 5.95%, or so minus $3,500, and then times 5.95%. Okay. So call that, for the sake of argument, $55,200. at not 4.95% like we're at today, but now 5.95%. That's $3,284. Okay. Plus on top of that, we're going to take 58.7 times 1.14. This is just another one of these things that is what it is. Okay. The 1.14 is in the legislation. So that's 58.7 times 1.14 gives me $66,918. That's what we're going to call the AMPE, the adjusted maximum pensionable earnings, which is a new figure. And if you happen to have federal pension clients, you're used to seeing AMPE as the average maximum pensionable earnings. Okay, so that's a different AMPE. So there's $8,218 over the YMPE figure. That amount we're contributing at a rate of 4%. Now that's tentative. We don't actually know that. That's what the proposal is. Yeah, I mean, I'm not gonna make you feel any better about it, Andrew. All right. So yeah, so this is just the employee portion. You're right, Mark, when all is said and done, we're gonna have to double this. So 328.72. Okay, so total then. Now, I just want to point something kind of weird out here. This portion, you get a tax credit for the employee who contributes. On this portion, because we love our rules, you're going to get a tax deduction for the employee who contributes. Okay, so you don't even have one sort of universal benefit across the board. It's now calculated, it's two different tax outcomes, which is going to put more money in your pocket, but it's one of those things where I just wonder about the benefit of adding all this complexity. So the total is $3,613.12. And then yes, times 2 for self-employed. So you're going to be up to 7226.24. Okay. And I'll remind you that we were at about $2,900 earlier. This is going to be for an employee about $700 more expensive with no inflation taken into account. And about $1,400 more expensive, assuming you make that much money for the self-employed. Okay. Now, what do you get out of this? What's the benefit? Okay, remember earlier I showed you that, is that the right number, Sean? That should be 3284 plus 328. Oh, wait, that's not exactly right, is it? That's close enough. Yeah, it's, I think I missed some pennies in there, Sean, but it's 3612 if you want, whatever. I just missed some pennies on the 3284. Okay. Okay, there's no change to retirement age here. Okay, that's not changed. Now, to change this, it does require the consent of the provinces. Okay, so the provinces have to agree to change the Canada Pension Plan. Okay, So what you get out of this, remember today, we're looking at YMPE times 25%. Remember that average 5 years of YMPE times 25%. That gives you your CPP max. Remember, that's where we very first started with this thing. Okay, so for somebody who is retiring after 47 years of this benefit, so 2025, it's fully in place, right? Add 47 years to that, and we get 2072. So somebody who is age 65 in 2072, that person will have a retirement benefit. They'll take AMPE, okay, 5 years of AMPE. They'll take the average of that times 33%, and that will get your CPP max. So ignoring inflation, that's going to be about $21,000 a year, whereas you might recall that today inflation was going to, or sorry, today's is about $14,000 a year, 14,110. Okay, so it really does result in an increased benefit. Okay, that is true. It's really going to take a while to get there. Okay, and for the folks on the call who wouldn't have very many years at the better calculation, it's not going to help you that much. For the younger folks, you're going to get more benefit out of this. So if you look at somebody who, let's say for the sake of argument, somebody who is 40 in 2025. Okay, you with me here? This person who's 40 in 2025. Well, for most of for that first 22 years, okay, so they have 22 years-ish. I know it's a little bit different than that, but call it 22 years at the lower rate, at the 25% calculation. Okay, there you go, Mark. All right. And by time Mark then is 65, so Mark will be 65 in, that'll be 2050, right? Agreed? So by that time, he'll have 25 years at the higher rate at the 33% calculation. So that'll all get blended together. And when it's time to figure out Mark's retirement benefit at age 65, assuming that anything is still the same by year 2050, but assuming that this all is the same, Mark would have, call it about half and half. So he would have about a 29% retirement benefit. Okay. Does that make sense? Sort of a blend of the two? Good. You see that the more years that you have on the right side of 2025, the more you'll benefit from these changes, although the more it will cost you as well. Okay, that's good. I don't know, Andrew. Man, I wish, I don't know. I mean, I wish I could count on people to save on their own. My faith in human nature is less than that. Yeah, yeah. Okay. Yes, they do. Sorry, Stephen, do they? No, not yet. I don't think so. No, they shouldn't. Okay. The CPP projections from Service Canada sort of assume a level from the point you're at. Okay. Now, I'll just show before we wrap up for the day here. So there is an assignment for chapter 4, and you definitely can do it right now. We're not done chapter 4 yet, but it's all CPP. That's all it is. So whatever, treat that as homework. Okay, we didn't even get to the afternoon slide deck yet. I'm a little bit behind. It's okay, we'll get it back. All right. I 100% agree with that, Mark. Do it while it's fresh. If you crack it open right now after class, you'll have the easiest time with it. The longer you wait from now until you do it, the harder it will get. Okay, any last minute questions before we call it a day? Okay, so we are on again. Next Thursday, that'll be the 21st. Yeah. No, I think that, and that's the day today, Stephen. That's how people feel always after the CPP day. It's just a lot of information. Okay. Yeah. Okay.
It's a lot of information, Jay.
I think it's a little soon for the quiz, Andrew. You can go try it. There's no harm in going to write it. Okay. I don't like, you might go write it and say, yeah, it's fine. It's not mandatory to do because we haven't done OAS yet. Right. Yeah. Yeah. It's just a lot of stuff. Right. So, okay. But go ahead and try it. There's absolutely no harm in that. Okay. Okay. I do think so, Todd. I think today is a lot of stuff, especially if you're in that sort of pre-retirement, but even with younger folks, still lots of questions here. I think today gives you a lot of ammunition for good financial planning type discussions on a fairly technical topic that people are generally mystified about. So, yeah. I do like this. I like going through the CPP stuff. I find it very useful. Okay. Tomorrow morning then, Esther. All right.
The only thing, Jason,
Yeah.
is you can overwhelm clients. So
Yeah.
I would never give them this kind of information. They would be like,
Oh,
they would
well,
shut you down.
we were 4 hours just talking about CPP. Okay. Not only would it be overwhelming, but it would be a terrible use of your time. Yes, I do have a planner, Andrew. I really do. All right. I'm sure I'm a terrible client though. Okay. Yeah, that's exactly right, Philip. And that kind of goes to my comment about my faith in people to save on their own. Okay. All right. Yeah, everybody have a great long weekend. It is a long weekend this weekend, which is kind of weird, eh?
It's been a long weekend for 7 weeks for me.
I don't know. All right. I don't think I've ever worked harder than I have this last 7 weeks, honestly.
That's true.
Yeah. Okay. Perfect. We'll see everybody next Thursday then. Have a great one. Thanks. Thanks, everybody.